The S&P 500 closed down 1.2% at 7,420.10 Zen. The Nasdaq Composite took a 1.3% hit to 26,021.66, and the Dow Jones Industrial Average swung a staggering 750 points from peak to trough to ultimately close down 1.0% at 51,492.55.
Yeah, that closing bell rang just 15 minutes ago on this Wednesday, June 17th, 2026. And man, we are looking at an absolute violent market whiplash.
Right, so the mission for today's deep dive is to unpack exactly what triggered this collapse. I mean, we need to look at the mechanics, figure out where the smart money is hiding, and map out what this means for your portfolio tomorrow.
Because the volume confirmation alone tells us this wasn't just, retail panic. It was systematic institutional de-risking into the close.
Yeah, today was the debut of the new Fed Chair, Kevin Warsh, and it clearly fundamentally rewrote the rules of engagement for the rest of the year.
The trading desks are actually already calling it the Warsh shock.
Well, to really understand the severity of that afternoon collapse, we first have to dissect the morning's false breakout. We had May retail sales hit the tape pre-market at 0.9% growth.
Which completely crushed the 0.5% estimate, by the way.
Exactly, it crushed it. And the market just sprinted. The Dow jumped 240 points to tag a fresh all-time record high, and the small-cap Russell 2000 soared 1.24% by midday. It's like you're running a marathon, you hit mile 13, clock a personal best, and you're cruising.
Right.
And then right at the halfway mark, the organizers announced the rest of the course is entirely uphill.
Yeah, and you're wearing flat racing shoes when you suddenly need climbing gear. That's the exact setup we saw today. If the consumer is spending, the domestic economy is humming along, and cyclical stocks rally on the expectation of higher earnings.
But if the economy is humming along, why did the market react like the sky was falling right at 2.0 p.m.? I mean, a 0.9% bump is objectively stellar news.
They panicked because of the 2.0 p.m. FOMC release. Now, the headline interest rate wasn't the catalyst. Rates were held steady at 3.50 to 3.75%.
Which is completely priced in, right?
100% priced in. But the summary of economic projections, the dot plot, delivered a hawkish hand grenade. 9 out of the 18 policymakers now project an actual rate hike later in 2026.
Wait, really? A hike? Not just a delayed pause, but an actual hike.
Yes.
So back in March, the market was pricing in cuts, and traders built their portfolios around returning liquidity. Now, Warsh is looking at hot retail numbers and signaling he might need to squeeze the economy even tighter.
That is the core causality here. The market instantly realized that a hot economy under Warsh means a heavy, unapologetic hand on inflation. Traders suddenly had to price in a higher-for-longer regime in real time.
Let's look at how that real-time repricing actually happened, because the volume profile is just fascinating. The second that dot plot hit the tape, the continuous cash market saw an absolute flood of sell orders.
It was a wall of high-conviction institutional exiting. If you look at the final 15 minutes, there was zero buy-the-close behavior.
None at all.
Absolutely none. The real money aggressively faded the morning rally. They used the green screens to trim risk and then systematically dumped assets all afternoon.
But this introduces a massive contradiction in the data. We have a 750-point swing in the Dow, systematic institutional dumping. Yet the VIX, the primary fear gauge, is sitting quietly in the mid-16s.
Yeah, it's actually down significantly from its June 9th high of 23.34.
Right. So if big money is panicking, why is the fear gauge so low? I know we had the U.S.-Iran geopolitical thaw over the weekend, but shouldn't a violent sell-off override that?
Well, the reopening of the Strait of Hormuz provided a massive sigh of relief for energy markets. Yeah. Crude dropped, and energy volatility is a huge component of broader fear, so that crushed the headline VIX. But the real mechanism hiding the damage is the dispersion trade illusion.
I want to break this dispersion dynamic down. The spread between the VIX EQ, which is individual stock implied volatility, and the standard VIX index is at an all-time high.
Exactly.
So institutions are heavily buying volatility protection on individual companies, but they are shorting the index level volatility.
That's the trap. They bet individual stocks will swing wildly, but because money is violently rotating from sector to sector, those single stock swings cancel each other out at the index level.
Oh, wow. So it's like a river that looks totally calm on the surface, but underneath the currents are ripping in different directions.
Or like pulling back a heavy rubber band. It looks static right up until it violently snaps. The market takes the stairs down and the elevator up. That quiet VIX is actively masking severe turbulence beneath the surface.
Well, if the dispersion trap kept the index looking calm, we need to talk about who was actually drowning in those undercurrents. Because the divergence between growth and value today was staggering. High multiple tech was decimated.
It was, and the gear turning that slaughter is discount rate repricing. When the Fed threatens a hike, the guaranteed yield on government treasuries goes up.
Which mathematically means the massive future profits of those tech companies are worth significantly less in today's dollars.
Exactly. The present value of long-duration growth assets mechanically shrinks. Institutions are forced to sell them to align with the new math.
And we saw that mathematical purge across the board. Meta platforms plunged 5.44%, dragging down the entire XLC sector. Microsoft dropped 3.8%, Amazon fell 3.5%, and Nvidia slid 1.3%.
The whole mega-cap complex was aggressively repriced.
But there is one anomaly here that we really need to dissect. SpaceX, ticker SPCX. Today was only its third day of public trading. It gapped up 3.5% pre-market, hit an intraday high of $225.64, and briefly overtook both Microsoft and Amazon in total market cap.
Which is just an unprecedented milestone.
But then it violently reversed to close down. Is SpaceX fundamentally revalued here, or is it just collateral damage from index reconstitution and institutional profit-taking?
It's purely collateral damage. When a massive company like SpaceX goes public, passive funds are mechanically forced to blind buy it to match their benchmark weightings.
Right, they don't care about the price.
Exactly. But today, the broader discount rate repricing forced those same funds to aggressively de-risk. SpaceX wasn't trading on satellite revenues today. It was trading as a highly liquid, high-beta growth asset. It was a victim of index-level liquidation.
So if long-duration tech was liquidated, where did that capital actually flow? Because industrials, the XLI, slipped just 0.14%. And LaZboy, ticker LZB, actually soared 19.1% today.
Defying gravity entirely.
I mean, a 19% jump for a furniture company in a weak housing market makes zero macroeconomic sense on the surface.
But it makes sense when you look at margin efficiency. They crushed their Q4 earnings. They posted $1.26 in adjusted EPS versus the 82 cents expected and announced a $300 million buyback.
So they showed incredible corporate execution despite the weak macro backdrop.
Right. In a risk-off environment, institutions rotate out of companies promising growth in 2030 and swarm into companies returning tangible cash flow today.
And Jabil Inc., ticker JBL, also stood out, right? They raised their 2026 outlook.
Yes, driven by extremely strong AI data center demand. The actual physical hardware cycle is still accelerating.
But the sources also contrast that domestic strength with BMW, which closed down 7% due to weak demand in China and Middle East supply disruptions. It just proves how highly localized today's market drivers are.
Absolutely. Global industrial giants are suffocating while U.S. domestics are thriving.
Okay, so with the carnage categorized, let's focus entirely on application. What does all this data mean for you when the opening bell rings tomorrow? With the Fed's forward guidance essentially dead, is the market destined for a free fall? Or is there a safety net?
There is a safety net. The options data shows a massive gamma wall sitting exactly at 7,400 for the S&P 500. It acts as a psychological and structural floor.
Because market makers are mathematically forced to buy the underlying stocks to neutralize their own risk at that level, right?
Exactly. That automated buying acts as a shock absorber. But if 7,400 breaks on heavy volume, the absolute line in the sand is last week's swing low at 7,237.
And a close below that opens the door to a severe 7,000 test.
Yes, it breaks the bullish market structure.
That's a pretty ominous technical roadmap. Do the historical probabilities actually suggest we get a full-blown capitulation tomorrow?
Actually, no. The data argues against a day 2 collapse. Trend days down, triggered by hawkish Fed surprises, only have a 35 to 40% probability of continuing. There's a 60 to 65% chance of consolidation.
Oh, wow. So what's the optimal tactical play mentioned in the sources?
A mean reversion long. Buying an early morning panic flush as automated dealers selling exhausts itself. Remember, the real economy is strong and energy costs are dropping.
So to summarize the core lesson of this deep dive, the Warsh era demands a highly defensive posture. Traditional forward guidance is dead, and the market is highly sensitive to the 10-year Treasury yield.
The Fed is now entirely data dependent.
Which leaves you with a final paradox to mull over. If the Fed is terrified of sticky inflation, does that mean good news is bad news again? If we get another blowout retail or jobs report next month, will the market celebrate the economic strength or immediately sell off in fear of that looming 2026 rate hike?
It's the ultimate macroeconomic tightrope walk. Strong data is now the biggest threat to multiples.
Keep your leverage tight. Remember, a quiet VIX can mask severe undercurrents, and keep your eyes firmly on the data.